Despite what you think, e-com founders make a lot less money than you think. You see all the revenue figures, and the reality is most of them are dead broke, and it comes down to one simple thing. I'm a chartered accountant. I work with e-com brands doing collective 8 figures of revenue. I've helped them save hundreds of thousands of pounds, and I see all the time founders doing insane, crazy revenue, but making zero profit. In this video, I'm going to show you exactly why e-com is so brutal when it comes down to what you actually get to keep. And I'm going to take you through step by step where you can see the money disappearing in your business so that by the end of it, you'll know exactly how to make more money for your business and ultimately how to take home more money as a founder. So, the cold, hard, brutal reality of business is that you are always last to get paid. This isn't a pessimistic view. This is just the cold, hard facts. And it's the risk that you take as a business owner. Think about it like a lunch queue. You're the person serving everybody, and everybody else is queuing up with their tray waiting to get paid. You have your suppliers, you have your employees waiting to get paid. You have rent and overheads to pay. There's software, systems, tools, the tax man, advertising platforms, any shipping partners, many other costs. And then if there's anything left at the end of the day, you get to take it home in a little doggy bag. That's your little profit. That's what's left after everyone else is paid. And that is what you get to pay yourself from at the end of the day. Now, stripping it back to basics, how founders and directors actually pay themselves. So throughout the year, you may take a small salary and it's tax efficient to do so. But the rest of it, the dividends you pay yourself at the end of the year, you can only pay dividends out of retained earnings. And it is what it says it is on the tin, right? The retained earnings is the earnings, the profit, that is left at the end of the year. And guess what? If there's no profit, there isn't going to be any earnings that will be retained in the business, and therefore you cannot pay yourself a dividend. The only reason why you wouldn't be able to pay yourself a dividend is if you do not have profit. Now, breaking this down simply, think of your business like a bucket, and whatever's left in the bucket at the end of the year is your profit. So you might expect there to be plenty of cash in the bucket. Money comes in, money might come out with expenses you would expect, and at the end of the year, there's going to be a big, healthy chunk of cash left for you to take and to draw on. However, the reality is very different from what you might expect. And oftentimes there is only a sliver of profit left, and in a lot of cases, there is no cash left. Again, like a bucket, you pour water in, the water level at the end, whatever's left, that's your profit. But as you would know, most e-com buckets barely ever fill up. They might fill up to some extent, but they leak straight out. And this is through what I like to call the leaky bucket analogy. Let's make this very clear. Revenue does not equal profit. People like to glamorize revenue and think that the business is growing, but at the end of the day, if there's no profit left in your business, you cannot pay yourself. So it doesn't matter how much money that you pour into the top via revenue, if there are holes in your bucket, the money will leak straight out, okay? And the holes are usually things that you can't see. So we might expect money to come out through other expenses, but these holes, they cause problems. Why? Going back to the analogy is that if your business grows, think about it, more money is getting poured in, it leaks straight out. And as you pour more money in, more money leaks straight out. And that is the problem. The more holes there are, the more problems you've got, the less profit you'll have at the end of the year. Revenue is just the number at the top. It gives you no indication as to what you actually get to keep. And as we keep coming back to, that is profit. However, there are a few different ways you can view profit, and I'm going to take you through 4 of them that should give you a very clear indication as to whether your business works and what you can fix to plug the holes, plug the leaks, and make exponentially more profits. So there's 4 different types of margins that tell you everything you need to know about your business. So some of these you would probably already know. So for example, you start at gross profit and you end at net profit. But using these 4 margin analysis is that we can figure out exactly where the bottlenecks are in your business, and you work via the top down. So you go step 1, gross profit, contribution margin, operating profit, and net profit. I'm going to take you through each of them step by step. Now, gross profit, you would likely know, I expect most of you to know this. It is effectively your revenue minus your cost of goods. So the money that you brought in for a product minus what you actually paid for it. That's your gross profit. You sell something for £50, it cost you £15 to make. That leaves you with £35, a 70% gross margin. It basically tells us how good your product margin is. The issue is that if this is low, it leaves very low margin for error for any other costs. So it doesn't matter how effective you are at cost cutting later down the line, if your gross profit margins are too low, that is the point at which we need to focus, and we will get to that later on. After gross profit comes contribution margin, and it is one that almost every single ecom founder overlooks, but it is hands down the most important metric by far that has to be tracked, like non-negotiable. And the reason why founders don't track it is because it's a bit of a hidden one. It can be a little bit confusing. People can't quite make sense of it. But once you understand it and break it down, it unlocks so much understanding of your business and the things that you can change, particularly in ecom, and I'll tell you why in a minute. Contribution margin is your gross profit minus all variable costs, so the costs that go up and down the more you sell or the less you sell, and that is your contribution margin. The reason it's called contribution margin is because it is the margin left that contributes towards your fixed overheads. So you have your variable costs and you have your fixed overheads. Breaking down contribution margin, you would have seen it's gross profit like before, revenue minus the cost of goods, but then we minus all other variable costs. So these are things like shipping, packaging, platform fees, any advertising spend that you have, and return costs. This is one of the biggest ones that most people miss, is that how much on average does a return cost you? And this is your contribution margin, £8. You can see very quickly it dwindles down because there's a few lines that, you know, in isolation you might think it's a bit small, meh, not that big. But when you stack them up, that is where it really hurts. And generally, this is where the biggest jump will be. It will come from gross profit to your contribution margin. And it effectively tells us how good the business model is operationally. After your contribution margin, you then have your operating profit or operating margin. And it's effectively the contribution margin minus the fixed overheads. And that takes us to your operating profit. So to take you through the waterfall again, you have your revenue. You sell something for £50. It costs you £15 to make. That gives you your gross profit margin of 70%, £35. You then have your variable costs, shipping, packaging, platform fees, ad spend, return costs. This here is your contribution margin. Remember, this is your variable costs. Then after that, you can't forget that the business has fixed costs that you need to pay. So for example, in this case, we've just spread out those fixed costs over the number of units that you have sold in that particular month or year. And on average, the fixed costs work out as roughly £3 per unit on rent, £2 per unit on staff, you have software and subscriptions, you have other costs, and that leaves you with £1.50, 3% operating profit margin. So does your business actually make money day to day? And this is where founders get it so wrong. All of a sudden, you have a gross profit margin, you think it's great, 70%, incredible. And then they jump straight down to operating profit, 3%. But there's such a crucial bit in between that, and that is the contribution margin. This is where the biggest jump in ecom tends to be, because operationally, this is where all of your costs are. And then at the end of the day, you're left with your net profit. So this is your operating profit minus the tax. The reality is we can't change tax, but now we're going to take you through the full water flow, the full system. So you have revenue minus your cost of goods, minus your variable costs, minus your fixed costs, minus tax, and you are left with a whopping 2.2%. Now this is what builds your retained earnings and is what you can take dividends from at the end of the year. This is your final net profit number. So that shows you, right, your 4 different types of margins: gross profit, contribution margin, operating profit, net margin. Each one of those indicates how effective your business is at different rungs of the ladder. Basically, the mistake that most ecom founders make, and it's through no fault of their own, is that they look in isolation at the net profit number at the bottom, and then you start guessing and you start panicking because you're not sure where the problems lie in your business. You see revenue at the top, and that's the thing that you check daily, right? You check your revenue and you think everything's great. And then at the end of the month, maybe, but most likely at the end of the year, you look at your net profit and you see very big revenue, but the net profit is tiny. And by not segmenting your profit like this, by gross profit, contribution margin, operating profit, net profit, you have no idea where to start. So it just feels so overwhelming. You start guessing and you start changing things in your business without any real method or understanding of what the moving parts are in your business. So that's why I've broken it down by those 4 different types of margins. And the reason I say it's like a ladder is because you need to work your way down. The further you go down, your profit will go down naturally because there's more costs coming out. But if you look at it in a methodical way, you can identify the pockets of opportunity and where you need to focus your attention specifically for your business. So we start with gross profit. If your gross profit is off and it's low, everything else beneath it will be low. It doesn't matter if you fix your variable costs or you cut your overheads. If your gross margins, so how much you sell something for minus what it costs you, if that is too low, nothing else will matter. So how do you increase your gross profit margin? Well, you simply either increase your prices or you negotiate better rates with your suppliers to reduce the cost of the actual goods. Every industry is going to be different, but you'll get a rough understanding by benchmarking yourself against competitors. And then once your gross profit looks healthy, then we can check against your contribution margin. And this is where in ecom particularly, there is always going to be the biggest jump. You're always going to see the biggest jump from gross profit down to contribution margin because of all of the costs that we spoke about, the ad spend, particularly the platform fees, the payment processing fees, the shipping costs, the returns. There are so many costs in there, and it's where most ecom businesses bleed. So are there any individual costs within that contribution margin calculation that we can check, that we can adjust, that we can negotiate on? Because when you do that at an individual level, it compounds out over all of the units that you sell. And then we have your fixed costs. Both might look reasonable, but if your operating profit is still thin, then we start to look at your fixed costs, because realistically a low operating profit could well just be a function of either low gross profit or a low contribution margin, not necessarily because your overheads are high. But I do see in a lot of cases overheads can be inflated, particularly employee costs. So it's a matter of, do those employees actually contribute towards the bottom line, or do we have big fancy offices that we don't need? But the reality is you're going to get the biggest bang for your buck with gross profit and contribution margin, because this will flex with the amount of units that you sell. So if you improve your contribution margin, you are going to see the exponential profit improvement across every single unit that you sell. Let's say you save £1 on contribution margin by switching shipping provider or reducing your cost per customer acquisition, just by saving £1. If you then sell an additional 10,000 units and you spread that £1 saving across that, that's going to generate you an extra £10,000 per month or per year. I can't remember what I said. And that's going to go straight into your retained earnings, and that's going to allow you to pay yourself more money. And this comes to the point of, you can't control your revenue to an extent, but you can control your costs. It is a lot easier to take something away that's already there than to create something that's not there already. Meaning you already have the costs. It's very easy to take them away, to get resourceful, to get efficient, rather than just accepting inefficiency and trying to drive more revenue. Because like I said before with the leaky bucket analogy, it does not matter how much money you pour in at the top. If you have an inefficient cost base, the money will just leak straight out. Whereas if you plug those leaks, you take those costs away, the more money you pour in at the top, the more that bucket is going to fill up, the more profit that's going to be there, and the more you can pay yourself. I've taken you through exactly why ecom is so unforgiving for founders, how by paying yourself last kind of puts you at a slight disadvantage because you lose track of profitability. But I've given you step-by-step ways to assess at each level how profitable you are, to identify where the bottlenecks are, where to focus your attention, to laser focus in on that, and ultimately how your business can make more profit. If your business makes more profit, you can pay yourself more money. So if you want to take this seriously, here's a challenge for you to do. It should be very simple. Pull up your profit and loss statement. If you don't know where that is, it's probably going to be on your bookkeeping software somewhere. And as we've been through, I've shown you exactly how to work it out. I want you to work out what your gross margin is, what your contribution margin is, what your operating margin is, and you should know what your net margin is because it will probably tell you. But I can always guarantee any bookkeeping software will not tell you is what your contribution margin is. And once you've done that, just take a look at it. Just sit there and look at it. And I can almost guarantee you, by being in your industry, you will probably have a hunch as to what you feel is right, as to what you feel doesn't quite fit. And something will usually look off, and you will identify gaps. Those gaps are exactly where the money is hiding. So gaps, I mean the jumps from each profit margin from one to the other. So from gross margin down to contribution margin down to your operating margin. Those are the gaps where you need to investigate further, drill down further into what actually makes up those costs and is causing those big margin jumps. That's exactly where the money is going to be hiding for your business. But if you don't want to do all of that, that's exactly what we do for ecom brands. And as I said, we work with collective 8-figure brands, added hundreds of thousands of pounds in pure profit by using these exact methods. We find the exact profit leaks in your business, and then we help you capture it. So If that sounds interesting and you as a founder want to pay yourself more money, but you can't quite see where the opportunities are, just book a free strategy call. Link in description, super easy, no strings attached. Absolutely promise it's going to be super valuable. As always, appreciate you for watching. Any comments down below in the comment section, and I'll see you next time.